Welcome to Market Movers, where we identify market moving headlines and discuss ways to hedge risk or create exposure in affected assets. We have Scott Martin.
Hi, Jim.
Okay, Scott, another big week. What's the biggest headline? More stimulus, some US, China / Europe trade tensions that might have implications for supply chain, fear rising regarding the virus. Which is the biggest of the three?
For today, Jim, I believe it's the fear regarding the virus, just because some of the numbers out of Florida, Texas, and some other states are a little bit concerning when it comes to some of the reopening procedures. But as you noted with those other two topics, the market is changing its focus a lot. So while the market may care about something for today, remember, as a trader, as an investor, the market may care about something different completely tomorrow.
Amen. Okay, so gold made a multi-year high. You and I have been talking about gold in here for quite some time. I still think it probably is going higher. Is this a concern about the dollar with stimulus and Fed dovishness, or is it like some sort of a panic flight to quality trade?
It's concerns and panic about a lot of things, Jim, I believe. I believe it's concerns about the economy. I believe it's inflection points when it comes to government and Fed stimulus. And I believe, to your point, too, it is concerns a little bit about the dollar because of all the money, quote unquote, printing that is out there, and the safety trade that tends to come into play when gold gets positioned in portfolios. So it's really all those things. And just to reiterate my thoughts on gold or the GC contract, I like gold, Jim, because it's not stock. It does not act like equity. So like it doesn't act like ES, and it doesn't act like bonds or like the ZN. So when it is placed in your portfolio, it has a, say, intimate value versus some of those other asset classes that you may own.
I agree mostly. I think it's probably more a fiat currency substitute and maybe a little bit of an interest rate play as well. The CME has a liquid gold contract, micro gold contract, liquid options that are traded weekly and monthly. Off to the NASDAQ now. The NASDAQ S&P trade has been a big deal. The NASDAQ still continues to outperform on the upside. And when we go lower, it seems like it kind of goes in lockstep. Do you see a thesis for a rotation, or is the NASDAQ going to continue to outperform?
I still like the NASDAQ NQs, Jim, versus the ES here, as we said all spring, and correctly so. The NASDAQ has the strongest companies on the street in it, in my opinion, whether you look at revenue growth, whether you look at gross margin. And so when you're thinking about equity investments, whatever your risk profile may be or your appetite for them given the day, I still believe the NQs and the NASDAQ stocks are where I would like to have my money.
Again, I don't disagree with you too. I think when it's the stay-at-home trade, we like the NASDAQs, and when it's the reflation trade, we like the best companies. Both are the NASDAQ. So I agree. So CME offers NASDAQ, Russell, S&P, and Dow. The regular mini contracts, the micro contracts, and liquid Monday, Wednesday, Friday, and quarterly options on those. And in the fall is going to be coming out the options on the micros as well. To the 10-year real quick. The 10-year has been stuck at 0.7. Is trade tensions, supply chain disruptions, is that affecting the 10-year at all? Or is this still the equilibrium between the treasuries offering them and the Fed buying them?
It's stuck at 0.7, Jim, is a great way to put it. I mean, my goodness, dead flat the last couple of weeks. It's all those things, and the fact, too, that the Fed is trying to steepen the curve, I believe. We've talked about this prior. And I do also believe that the issuance of bonds is coming into the picture here, as well as the fact that there's a lack of inflation. So given that we're still in this economic uncertainty as it relates to the virus, as it relates to just the general economic recovery, I don't see yields moving too much of anywhere.
See, I'm hopeful that when the stocks start to rally and the recovery really comes, that hopefully long end yields go higher. And I think that's where the breakout's coming. Thank you for joining us on Market Movers, where we are helping to make you a better trader.